just put your head on the pillow at night and sleep soundly because you know
Yeah.
that dollar amount is there. Like that magic number I talked about. Most people have it. And why lose sleep, right? In the big scheme of things, money is just a tool to provide you with the lifestyle that you want to live and want to have. And is stress really going to help you live a happy and worry-free retirement or worry-free life? Probably not.
Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
Welcome to The Informed Investor. Today, we're going to dive into the three major buckets that make up your wealth experience. The Informed Investor is brought to you by Dimensional Fund Advisors, a global asset manager bringing financial science to investing. Now, you might notice a little bit different background here today. We are coming to you from our Charlotte, North Carolina office, where we are hosting an event for financial advisors. And we are very fortunate to have one of those advisors join us on the show today. So, Jason Smith, great to have you here. You are the executive chairman of Prosperity Capital Advisors, also founder of the firm. So thanks for joining us here today.
Oh, thank you so much for having me. It's a pleasure.
And by the way, I got to comment, I love your swag. Prosperity
Thanks.
Capital Advisors, Dimensional, I think we can do a little bit better.
Yeah, it's comfy too. It's comfy too.
Hey, tell us a little bit about your firm, a little bit of background, how you got your firm going, and the type of clients you work with.
I started out with my own firm in the greater Cleveland area, and it's been 30 years. It's hard to believe I've been in this business. And 15 years ago, we decided, we could only help so many American families in the greater Cleveland area. So we decided to start helping other financial advisor entrepreneurs, grow their business. So we built a coaching and mentoring platform and helping them manage their money, a lot of the back office stuff, and, basically becoming a resource for other financial advisor entrepreneurs. And so we've been doing that too over the last 15 years. Yeah. So it's kind of been a dual B2C, kind of helping the clients, as well as B2B, supporting other financial advisor entrepreneurs that believe
that's
in
a
DFA.
Great way to summarize what you guys have been doing there. And we've had a great relationship, worked together for a number of years between the firms here. All right, let's get into it here. One thing we like to do on this show is read a few headlines. I'll read some of them, and then we'll get a reaction. It'll kind of set up some of the things we're going to dive into here today. All right, a couple of headlines here. How big should your emergency fund be when you're retired? 5 expenses most retirees still underestimate. And the last one here, how to avoid outliving your retirement savings. It's all in the sequence. All right, now listen, when we talk about these things, there's a lot of how to, what should it be? I think when you think about a wealth experience, it can get very complex, which really was the genesis of the book you wrote. Right, The Bucket Plan.
Yes.
And so maybe tell us a little bit about what started that book, and then we'll dive into those 3 buckets. And I got some questions for you around that.
Yeah. So what started the book was, and actually I'm even going to go back a little bit, Mark, and tell you what started the 3 buckets, right? So I did not know this at the time. But bucketing, this concept of time segmentation in buckets based on the purpose and the time horizon of when you need to or want to access those funds, this concept's been around for a long time. So earliest kind of sightings is Harold Levinsky, I think out of Texas Tech, right? Was, the first one that people heard talking about this concept. And so it's been around the industry for a long time. I wasn't aware of all this. I was actually not using buckets for many years. I was using boxes, right? And what it was is I would at first it was a notepad when I was meeting with people in their offices or in their homes. And then ultimately it turned to like kind of up on a dry erase board. And I would draw these 3 boxes, and within the box and above the first box would be written the word now, the middle box soon, and the third box later. And I would talk people through kind of the concept of like, hey, there's a certain amount of money you want safe and liquid, typically money you keep in the bank for emergency fund, planned expenses, And ultimately just that kind of, you can put your head on the pillow and sleep at night when you know that number's there, right? You know that number's in the bank and you're cool. We all have that number. It's like a magic number, that really just puts you at ease. And so I would talk through like what they currently had, right? And we'd write those dollar amounts in that first box. And then we talk through the soon box. And the soon box would be more about, is there a certain amount of money that you want to invest more conservatively? Certain amount of money, you don't want to leave it in the bank and not keep up with inflation and sacrifice the rate of return you could otherwise earn if you were to have it invested, but you want it more conservatively. And maybe if you're nearing retirement, this might be money that you need to draw an income off of, or a series of withdrawals that are going to be coming. And there may be something in the time horizon, let's say over the next 10 years in that soon box, you want to allocate funds that are going to be available, invested more conservatively, and ultimately be there when you need it, right? If the market's down, you're not going to need to access them.
Yeah, you still got it. Would that include things like, okay, I have to get a new car in 5 years, or I've got a kid's wedding in 10 years or something, that kind of stuff?
Absolutely. All those things are kind of talked through. And that's the kind of money that, because you have a shorter time horizon, you need to invest it more conservatively. So I would write their accounts, right, in that soon box, and we would talk through what they had allocated. And then the rest of the money is really that later right box, where in the way I would explain it is, that later box is more for long-term growth and legacy planning. So it's the money that now we bought a time horizon between the now and the soon money, we can confidently invest the rest of the money in the later box, right? And so in appropriate investments, and we would even score, and we still do today, the soon money differently than the later money, where when you do a volatility tolerance analysis or a risk questionnaire of how much risk you're willing to take to how to determine how you're going to invest the money, we'd score the soon money different than later money to determine what the appropriate strategy or investments would be. And then the legacy planning piece is, a lot of husband and wives, they think of legacy planning for the kids. But see, legacy planning is not just for the kids, it's most importantly for the surviving spouse. Because when one spouse passes away, if they're both on Social Security, one of the checks goes away. There could be an adjustment in pension income. There could be part-time job of that spouse, or, but ultimately, almost always income goes down, but yet at the same time, income taxes go up because the brackets go from married filing jointly to a single filer. Right. And for that same amount of income, they're going to exponentially pay more in income tax usually. And so it's kind of a double whammy, and they don't think about that legacy planning, not just for the kids, for their surviving spouse. And so I would kind of go through, okay, what money do we have allocated for later? What do we have for soon? What do we have for now? So I'm sitting with Glenn and Judy, and I never forget this, and I draw their boxes are up there. They're now, soon, and later. And we have their dollar amounts. And what I would do is I would total the dollar amount of all their accounts in each of the boxes up at the top. And that day, for whatever reason, I circled each of the $3 amounts. And Glenn said to me, "Hey, Jason, those look like buckets." He's like, "I've always had a bucket list, but I've never had a bucket plan."
There you go.
I'm like, no way, right? Yeah. So I go home, I tell my wife, she starts working on getting a trademark. So we ended up trademarking the bucket plan and 3 buckets and blah, blah, blah. And, kind of built out our whole holistic wealth management process around it. But that's how the origin, then I found out bucketing's been around forever and all this good stuff. So that's great. But I ended up writing a book, and I was sharing with you, Mark, the other day, what really drove me to write this book, because I'm very passionate and have been for the last 20 years around holistic wealth management, or 25 years maybe, really bringing together, because ultra high net worth people have gotten this forever. It's a family office, right? It's where the tax professional, the insurance, the investment, the legal, they all coordinate on behalf of the client to make sure they're getting a fully integrated, holistic wealth management plan and experience, right? It's the plan is built and it's managed appropriately with all these areas coordinated. But most people don't get that. Most people, there's an investment person, insurance person, a tax person, a legal person, nothing's coordinated. And so I've been very passionate about that coordination, throughout my career.
The other thing that jumped out to me is you talked about the bucket plan is the idea of three, I think helps.
Yes.
I almost go back to a preacher. Like when they do a sermon,
Yeah.
it's like, I got three things to say.
Yeah.
Because four is too many.
Yeah.
Two's not enough. Three, I think our mind is wired to
100%.
to track on three.
Steve Jobs' biography is where actually, it's funny. I used to, at first it was two, right? It was more of like a now and later kind of thing. And then over time it evolved into the three because I saw the need for that middle bucket, that money that's invested conservatively, but you don't want to sacrifice the rate of return that you would by having it sit in the bank, right? You don't want to have too much there, but you need to, because you have a shorter time horizon and you're going to need to access that money for income or withdrawals over the course of or within the next 10 years, you got to invest it different than the later bucket. And that's kind of how it ended up evolving into three. But then for a short time, I was like, okay, that later bucket is really two components. It's 10 plus year time horizon before you're committed. You're not going to touch it for 10 plus years. And, but purpose of it, the purpose of the money, long-term growth, and legacy planning. So it's kind of two different purposes. So for a short period, I'm like, oh, four. And then I was like, almost like four buckets or boxes, whatever. And then I read the Steve Jobs book, and he talked about how it was so important to never go to four in any of your messaging for how the human mind comprehends and retains information. It's in threes, and there's a huge drop off when you go to four. And it's funny because you said this to me, and I'm like, you know what? That's why it's three buckets.
That's
so
great.
it's long-term growth and legacy planning, or
Well, let me ask you a
later.
couple questions as you go through these buckets. And the beauty of that is I can insert myself into it.
Yeah.
And so let's say you go to the now bucket. So I think about, let's say, my kids. So
Right.
they're 24 and 26. They graduated a couple years ago from their respective schools. And they were asking the question, like, how much savings should I have? Like that savings I have immediately right now because the car breaks down, or
Yes.
like, how do you think about how much a 24-year-old should
Yeah.
have versus, say, somebody like me, 58?
Yeah.
I'm sure that those are two very different things you want to think about. What would you tell somebody like that?
One component of the discussion is certainly the planned expenses, right? What things do you know are on the horizon over the course of the next 2 to 3 years that are coming, that you want to make sure you've allocated the appropriate amount of money, to pay for those expenses. You're not going to invest that money, right? I mean, with that short of a time horizon, no way, not even in the soon bucket, not even conservatively. You don't want to put it at risk of being down at all. You just want to have it, like allocated for in the bank. So the planned expenses is definitely one component. The other component, when you're thinking about an emergency fund, I mean, at minimum, you want 3 months worth of expenses. Hypothetically, if you lost your job, right? Some people even up to 6. Depends on how conservative you are. It also depends on, how stable, you feel like that income is for you. It also depends on, if you're, in your case, Mark, you might have a home equity line of credit that you don't have any on, right? Like you haven't used it. And so that can be your emergency fund. So do you need to sacrifice 3 to 6 months worth of expenses and then bank sitting there? I mean, interest isn't that bad right now, right? But sometimes it's nowhere near as good as it is today. And, but even still, that's a consideration. Do you have another place you can go, home equity line of credit, where a true emergency happens, you can go get to it, and then you could always pull money off of investments when the timing is right. The key is you don't ever want to put yourself in a position where you need access to the funds and the market's down and you're forced to sell when the market's down, because you can never make that money back, right? And so that's the purpose of like that emergency fund component. And then the last kind of like thing to really think or talk through is the comfort piece of it, right? And is there a certain amount of money that, listen, you understand the emergency fund component. We checked the box there. You're covered. You understand your planned expenses. Okay, we talked through that. We got that in the now bucket. The third component is like, just put your head on the pillow at night and sleep soundly, because you know that dollar amount is there. Like that magic number I talked about. Most people have it. And why lose sleep, right? In the big scheme of things, money is just a tool to provide you with the lifestyle that you want to live and want to have. And is stress really going to help you live a happy and worry-free retirement or worry-free life? Probably not. So having the appropriate amount of money there, and it's funny, I have a 28-year-old daughter, similar, a little bit older than yours. And my first thing was really helping her understand as a young adult that now bucket, right? Because there's a lot just to that. Look at that.
Oh, yeah, absolutely.
Just to talking about the now bucket.
I was thinking about my folks too, where they had, and you said everybody's different. Their mental set was, I want about 15 years, 15 years of spending covered.
Yeah.
And then the rest was in that long-term growth equities.
Yeah.
And that was just worked for them to where, one, it avoided a forced sell, but two, it was, if the market goes down 50%, I'm good.
Yeah.
Because I've got my 15 years and I'm probably confident.
Yes.
15 years later, that'll probably come back.
100%.
Right? So it helps discipline in the market too.
I'm so glad you brought that up, Mark, because like 10 is kind of the default starting point placeholder. And honestly, most people 10 works, right? But there are also younger investors that are entrepreneurs or business owners or just younger in general that are like, you know what? I don't want 10 years. Like, I don't want that much capital like in the soon bucket. I'm willing to shrink that down to maybe 5 years, right? Of thinking through the next 5 years of expenses and, income or withdrawals or planned expenses. And so I'm going to invest this amount of money, a smaller amount conservatively, so I can put more money into the later bucket, right? And so they don't want to, and so I think anywhere from 5 to 15, or your parents' example, they wanted to go 15. And so it's very customized, similar to the conversation we had about the now bucket. You have to customize that, right? To ultimately every person you're talking to.
All right, I'm going to go a little different direction here, which I think is helpful for the audience to hear. Maybe there's gaps, or I'll call them mistakes, perhaps, where you've seen prospects come in and where you've seen some mistakes. I'll call them gaps, maybe in those different buckets. And you mentioned this idea of holistic wealth management, where you got really everything that's important as part of that financial experience, right? The tax, the estate planning, insurance, of course, the investments.
Yes.
Where do you see, as you walk through some of the mistakes made? And I'm going to have you tell your story, because I think it's a powerful way to set up on the insurance side, where you might have some mistakes there. So I'd love for the audience to hear your story around that.
Yeah. I mean, specifically, we'll talk about, because since we already touched on it, I think it's most relevant, the soon bucket and why it exists, right? Because as I said before, used to be now and later, right? I mean, that was for the most part what it made up of. And then that's what most investors, most people you talk to, they have a little bit of money in the bank, and the rest of their money's all in the later bucket, in essence, invested in a way that is more long-term growth oriented, et cetera. And so that's a pretty common setup that we see. The evolution of why the soon bucket kind of, was created and why it exists is because when you have that money invested that you're going to need to access sooner rather than later, and you subject it to what's called sequence of returns risk. And this is something that, easily can be looked up on Google, Chat GPT, Claude, whatever your YouTube, whatever your preference is.
It would be interesting to compare the answers to that question. Right?
But the general definition and premise is the same. So I'm not going to go into too much detail, but because we already touched on conceptually at a high level, it's the effect that, selling money early in retirement when the market's down, having to liquidate some funds, the long-term effect it can have on the longevity of your money and possibly outliving, your money in retirement. And so it's important, and you never want to you want to protect against that. It's one of the biggest and most important risks to guard against, and so when it comes, the reason we created that soon bucket is, there's a money cycle. And even more specifically to someone who's preparing for or already in retirement, let's talk about the money cycle. It's got 3 phases. You're going through it right now. I'm going through it. We all go through it in our lifetime. Every person does. And the first phase of the money cycle is the accumulation phase. Accumulation phase is when you're younger, you're working, you're preparing for retirement, you have a long time horizon before you need to access the funds, and you can afford to take more risk. Because if you lose the money, you're working, you can make that money back. If the market goes down, you can wait it out and that money can come back like you talked about with your parents. But in the accumulation phase, you can afford to have those things happen, and you got all the time in the world, right, for the cycle to continue. But the second phase of the money cycle is the preservation phase. The preservation phase is where you start to preserve a portion of your assets that you're going to utilize in the final phase, distribution, when you go into retirement, right? And the biggest mistake that people make is they go directly from the accumulation phase into the distribution phase. And they never preserve a portion of their assets that they're going to take income or withdrawals from in the first phase of retirement. Therefore, they subject themselves and their plan to sequence of returns risk. And that's why the soon bucket exists, is to preserve a portion of the assets that they're going to use, in that time frame and not subject themselves. So I would say sequence of returns risk is one of the biggest risks.
And that's just saying, hey, if the market happens to go down significantly as I enter into retirement and start accumulating or spending, I don't want to have to sell assets at a low level, right? I've got that safety money, if you will,
yes,
or the soon money you can rely on for that the stocks to come back
to weather the storm. And it's almost like a bridge, right? The soon bucket, think of it like a bridge to get to the later bucket. So you're buying a time horizon, or you're buying a bridge of money to never put yourself in a situation where you have to touch that money that's allocated predominantly towards growth, and therefore more volatile to the ups and the downs of the market.
Okay. Yeah. Thanks for clarifying that one. Yeah. So let's go back to your story then, and kind of from the insurance side, because I think that's something that I've talked to friends about it, and I think it's a little bit misunderstood, and probably from my standpoint, probably a mistake, a gap people have when they think about the role of life insurance and where it can meet a need. So tell us your experience around that.
Yeah. So, insurance is, in my opinion, the 2 biggest ways that we're leveraging it in an overall holistic wealth management plan. One is to make sure that if the unexpected happens, so think of it as you're using it for the unexpected, and then you're using it for the expected. So on the unexpected route, you need it in place to pay off a mortgage or replace income if you're a ways out from retirement, all the traditional ways that people have, come to know about insurance. And so, that's an important piece for sure. And a lot of people have that, that box checked, right? Or should. In my experience, funny you say about my story, this just kind of bubbled up for me. And, I was, my dad was an insurance guy, right? That's how I originally got into the industry. The funny thing is I said I would never, do anything with insurance. You
Yeah,
know
of
what I
course
mean?
not.
Like, of course, I don't know what
I'm
to
not
do.
following Dad's footsteps.
Yeah. And that's how I entered the industry. But truth, I was always really fascinated and enamored with the stock market and the investment side. And I truly wanted to be an attorney. And that's kind of why my career path took me down. Like did a lot with estate planning, became a certified estate planner. Then I added tax planning and management and preparation, bolted that on, and then the investment piece. But the insurance is how I actually started out in the industry. And I do think, it's important that first, boxes is checked for sure to cover the unexpected. But because like for me, when I was 29 years old, I was doing very well in this industry, very blessed. And I was, playing like in a rec basketball league, right? And I came home one night and my heart was beating all funny. It was kind of like skipping beats and beating irregular. I didn't know what was going on. And long story short, I end up in an emergency room and I'm diagnosed with, an irregular heartbeat and a small aneurysm and a heart valve that would eventually need open heart surgery, right, to be repaired or replaced. And it just was like, hit me like a ton of bricks because I had a beautiful, like loving wife and young daughter that I referenced earlier. And I'm on top of the world making a ton of money and, life is good. And then I'm like, oh my gosh, if I die tomorrow on an operating table, my income dies with me.
Yep.
And my wife and my daughter are in a really bad place. And unfortunately, I was a shoemaker's kid and I did not have any life insurance in place. At 29 years old, I thought I was invincible.
Yeah, exactly.
It's almost embarrassing when I tell the story, but it is what it is. And so at that time, that's when I decided I really needed to figure out how to build a business that could operate without me, right? And kind of take care of my wife and kids. If God forbid I did die on an operating table, which thank God I didn't. I had the surgery years later and all is well now. So all that stuff is cleaned up and taken care of. But that's a good example though, where, I think a lot of young people and professionals don't lock in their insurability in case the unexpected happens, right? And so any of the listeners, if you have if you have kids or you're in your late 20s, early 30s, and you don't have the right term life insurance, that stuff is dirt cheap.
Very inexpensive.
Right? It's like you're just being lazy, right? And irresponsible if you don't just get it in place. Yeah. Especially after hearing this story. And I'm going
to even tell a story too. I've had a friend, you can see where this is going, in their 30s, a couple of young kids, and unexpectedly just passed away from a heart attack.
Right.
And there's no life insurance. And so the income goes away, right? And I think the wife and the kids had to move and go live with her folks because they didn't have the life insurance. And so you think how emotionally incredibly challenging that is. And then on top of that, you're having to change the cities and the kids have to move. And that could have easily been avoided with very inexpensive term life insurance, right? So takeaway for the audience, absolutely make sure you have some level of life insurance. And there's different needs, like you said, replacing a mortgage perhaps, or certain levels of income, or maybe it's even because it's so traumatic, you might say, I want a certain amount of money where I don't have to work for a year, right, to get through that time. But there's just a whole bunch of things that come into play on.
But, Mark, value. Even it's very relevant to what we were talking about, even for like a pre-retiree, right, that's within 10 years of retirement. I mean, those are your highest earning years typically. And so it's a big loss for your surviving spouse to not have that 5-10 years worth of income that they were going to rely on. Plus, so all of a sudden it's like loss of income. Then you have income taxes going up substantially for them as a single filer versus married filing jointly. And, it's just not a good experience. So, even in that stage where you're within 10 years from retirement, you should have the right life insurance in place. That's all unexpected stuff, right? So you go over to the other category of the expected. We're all going to die at some point, right? I mean, it's just unfortunately,
the quest is still there, but
Elon Musk hasn't figured out how that not to happen yet or whatever. The other big mistake I see a lot of people make is, and listen, we've all been told to do this, just sock away the most amount of money in IRAs and 401ks, right? I mean, we've heard that forever, right? It's just been like the basic advice that we've gotten from financial advisors and industry and government and everything else. But the problem is when you have so much concentration of pre-tax money that ultimately is 100% taxable as ordinary income when you draw it out in retirement. And then ultimately, if you pass away and your spouse has to draw predominantly just off that, it's like a tax time bomb that goes off on somebody at some point. And so...
And sorry, you're talking a traditional 401k plan,
traditional 401k, traditional IRA,
plan.
Or even thrift savings plans and Kia, like a lot of these where you've never paid tax on the money yet, right? You took a deduction of the money going in, so you're deferring it all, and it's growing tax deferred. But then when you go to take it out, it's 100% all taxable. Income. And it can trigger your Social Security to become taxed at a really high level and all kinds of stuff. So the other big mistake I see people make is they don't explore and utilize the opportunities that they have in Roth IRA and 401k and HSAs and FSAs for, putting money aside in a more tax advantaged way. So when you draw it out, if you follow the rules, it's all tax free. The other is cash value life insurance. I mean, that's a place where you can, very similar to a Roth or an HSA, where you can accumulate funds internally and then draw it out in a way where you can access those funds tax-free. And then ultimately, when you pass away, it goes to your spouse tax-free, it goes to your kids tax-free. So that's the expected way that a lot of the, wealthiest people in the world have been using it for a long time. And I think a lot of those kind of middle-class millionaires, hardworking American families that accumulate a lot of wealth, they're too concentrated in all pre-tax money, and they haven't diversified amongst the other types of tax, advantaged accounts that they could utilize.
It's a great way you said that, which was, we talk a lot about diversifying on the investments, right? You want to own really all the stocks and bonds you can, but diversifying on the tax side of it too, I think is a really powerful comment there. And so just maybe give a little commentary around what you mean by that. So let's say you have most of your money in the pre-tax contributions in a 401k statement.
Right.
Like somebody can go in and participant and say, hey, I want to start contributing after tax, right? Kind of the Roth part of a 401k.
Exactly.
Maybe just give a little comments on how somebody can go out and do that, start diversifying their tax exposure.
I mean, first and foremost, I mean, the thing that you typically want to do is you always want to take advantage of the match, right, in your 401k. So you want to contribute at least up to the matching amount because it's kind of free money that's on the table. You don't want to leave free money on the table, right, that your employer could be contributing. So the mistake I see a lot of people make is budgetarily, cash flow wise, they max out their 401k. They put the most amount in, and then the free cash flow they live off of, it's just enough. And so they don't allocate money into, the first order would be Roth IRAs in this instance, in this example, right? And so so one of the things you could do is you can dial down your contribution in your 401k to just take advantage of the matching, but take the rest of that excess cash flow and put it into a Roth IRA. Or if your 401k has a Roth option, which most do these days, then you can allocate that other portion into the Roth account. Because the Roth account is so beautiful because I'm a big fan of it. The bulk of my retirement assets are all in Roth because I've contributed, I've converted. There's been windows the government's given us 2 different times where you could do conversions, spread it out over 4 years, 2 years. I've done partial conversions over the years where I've converted. So I've tried to get as much as I can into Roth tax status because if you really think about it, we'll use a farmer analogy, right? If you're a farmer and the government, right, the IRS says to you, hey, you have a choice. Do you want to pay tax on your seed or do you want to pay tax on your harvest? Which one are you going to choose? So you
I have
think
a
about
50-50.
that. Sorry, I threw you.
I'm going to go the harvest.
Yeah,
I'm going to go the
right.
harvest.
So the harvest, right? So if you the
Because
seed,
you're paying tax on, what you have. I mean, that's what my thinking was.
yeah,
on
no,
that,
that's
right?
good. So in there's an approach where you can do the mix of the two, but conceptually, one thing to think about, right, is in a Roth account, you're putting in $5,000 that eventually could grow to be worth $50,000. So by putting it into Roth, you have to pay the tax on the $5,000 because otherwise, if you put it into a traditional, you get a tax deduction on that $5,000. But the difference is now that's tax-free forever. That $5,000 can grow in compound tax-free. And when you pull it out, if it's worth $50,000, 20 years from now, that $50,000 is all tax-free. So there's merit, right, in paying tax on the small seed instead of the giant harvest later on.
Yeah, the big growth of that. Right.
But I think diversification's key, right? So it doesn't mean I don't have pre-tax money in my own situation. We advise clients to have pre-tax money as well. So it's diversifying, your different tax strategies, but predominantly the way I look at my retirement accounts is I'm probably not in a situation where I'm going to need to use it because I plan on working forever. I love my job. I love what I do. And so more likely it's become for legacy planning. So I would rather have that money pass on tax-free in the Roth account opposed to if it's in a pre-tax, it's kind of like that tax time bomb that goes off on my surviving spouse or my beneficiaries.
You were talking about diversifying it. The word was coming out to me too, just additional flexibility you have, right? When you have both buckets there,
right,
of the pre and after tax. So if there's somebody listening to this going, I wonder where I'm at in my own situation. Let's go back to your book, the bucket plan. And you have kind of a self-assessment area within the book,
right?
Maybe walk us through that and how somebody might use that to assess where they are.
Yeah. So, one of the things that we kind of do, throughout the process is, first of all, there's a questionnaire that you fill out that's kind of part of our discovery process, but it asks a ton of questions around, what you have in place for estate planning, what you have in place for tax planning and management and preparation, kind of how all that's working. A lot of people are just getting preparation done. Nobody's really doing planning and management, right? And looking for some of these things we've, briefly just touched on here. What do you have in place for how well do you know what your investment management looks like? Do you know what all the internal fees and expense ratios and operating costs and how much you're actually paying to your advisor? All those things, like we want full transparency. Do you even know, right? Most people don't, right? So we're asking a lot of these questions around the insurance, same thing. Do you have an umbrella policy? It's shocking how many people, right, have accumulated, really good few $1 million and more, and they don't have an umbrella policy, right? And
it's their kids are driving and you have a swimming pool. All kinds of crazy things,
right? So it's just looking at and making sure I's are dotted, T's are crossed, and we already talked about life insurance and how cheap term life can be. So I's are dotted, T's are crossed around, all the different insurance, investment, tax, legal and estate planning. It's all talked about in that questionnaire. If people do nothing else, I've had multiple people tell me this, in just going through the discovery appointment, which is about 90 minutes with us, they learn so much about the gaps and what they have. They could never talk to us again, and they have a punch list of what they need to go do to improve their situation. So, that in itself is a large part of the self-assessment. But then we go into education mode, and now we start educating on the money cycle. Another tool that we won't go into, called the pyramid of risk, right? And ultimately what those different types of investment vehicles are and what their experience are and how much risk, from top to bottom and expected rates of return, et cetera, in the 3 buckets, right? And what do they have in place now? So what we'll do is we'll do a before and after bucket plan. Based on where they're at right now, this is what their now, soon, and later bucket looks like. Now we understand what their goals are, and now ultimately, here's the after of what we would recommend, in that later bucket, or in each of the buckets, in the now, the soon, and later, based on all the questions we ask. So the self-discovery kind of happens within the questionnaire that's initially done in our discovery phase. When we go into the design phase, it's educational and it's information gathering, to then go to the third phase, which is delivery. And in delivery is where we're going to deliver their recommended new 3 buckets with a punch list of what needs to get taken care of for financial, tax, legal, insurance, estate planning, et cetera, to make sure that, their plan's in good order. And then if they decide to hire us to become their wealth manager, then at that point we go into execution, implementation, and we do all that work for them. If they want to do it themselves, at least they walk away with a clear blueprint of what needs to be done.
So you have a couple options there, and I'm going to follow up on the comment you made of if they want to do it themselves. To me, the key to that is you have to do it. Right. You have to go do this stuff,
right,
and get it implemented and get it done. If it gets complex, which it is complex, you need some help, go reach out to a financial advisor, right, and get that professional advice, because they'll hold you accountable to get it done too. And just my point there, and we've talked about this, of a decision to do nothing is a decision. If you don't do anything, that's still a decision, right?
Absolutely.
You're just not doing anything. So
no
make
decision is a decision.
Yeah.
Yep.
So go do something and make sure your financial affairs are taken care of for those unexpected events.
I mean, listen, Mark, I have a financial advisor. No joke.
There you go.
I have a financial advisor, and they meet with me, and we do a 2-chair approach for high net worth, high income individuals. I'm a client of my own firm, and the 2 of them sit down with me and my wife every quarter, and they update our asset sheet, which is kind of like our personal balance sheet. They keep everything in order. 2 times a year, we're doing a more thorough review on tax and investments, on estate planning, on insurance, and we're making sure it's always evolving, and our bucket plan is always evolving, because every year you need to make little tweaks and little changes. Like, your parents' example, right? Where you said they want 15 years.
Yeah, right.
Well, if we created their bucket plan today, in 5 years from now, they only have 10 years left, right, of that soon bucket. So you really need to be managing this on an annual basis to make sure the plan, stays up to date, right?
Well, it's a great example of you having an advisor, because you know this stuff. You can do it, but you don't want to spend the time on it. And then you certainly want your wife involved in all of that stuff.
I needed accountability.
Right. Yeah.
Like I have a personal trainer because I need accountability, right? I have a coach because I need accountability. Like, some people are amazing and I'm jealous because they can just do it all themselves and self-motivated and no accountability. For me, I need accountability. And that's why I have a financial advisor, even myself as a financial advisor.
All right, listen, thanks for your thoughts on that.
Yeah.
And congrats on the book.
Thanks
the
so
success
much.
you've had with that. The bucket plan is really awesome, and appreciate your time here today and all the great knowledge in the conversation.
Yeah, Mark, I've thoroughly enjoyed the conversation. I love it. Thanks for having me. It's an
Thank
honor.
you. And hey, thanks to all of you for joining The Informed Investor. We appreciate your time. And just remember what we talked about here today. If there's a gap somewhere in things you need to do, just go do them. It's going to be well worth it to protect against the unexpected. Thanks, everybody. Have a great day.